Over the past couple of years, Meta Platforms has been a rocket ship. Look at this. In the past year alone, they're up around 96.3%. And if we zoom out and look at the past 5 years, yes, they're up around 224%, but it's been a very rocky ride. If we look right here, in late 2021, the stock got up to around $376 per share. And if we jump over to my stock screener and come up here and plug in Meta, what we'll see is if we come over here and look at earnings, we can see earnings plummeted by quite a bit in 2022. In 2021, it was $13.99 and then dropped all the way down to $8.63 per share, and the market panicked. We can see again, going from around $380 per share and sold down all the way to around $93 per share. So again, a massive sell-off. And since they hit that low in October, we can see they have more than 5x, going up to around $591 per share now. And also during this time, the company announced that they're now going to be paying dividends. So if we jump over to my dividend breakdown sheet, let's get a quick idea of what this looks like. We'll plug in Meta. And what you'll notice is most of this data isn't going to load in, but again, that's because historically the company hasn't paid a dividend. Now the dividend right now is very, very low. We can see it's sitting at just 0.34%. So why would Meta do this? Why would they announce a dividend payment when it's going to be so low? Well, you have to understand capital allocation and how management makes decisions with their capital. There's 5 different things they can do with their free cash flow. They can reinvest back into the business, which tech stocks like Meta do quite a bit of. They can buy back shares, pay down dividends, pay down debt, and also attempt mergers and acquisitions, which Meta has done in the past before. Keep in mind, they bought Instagram for around $1 billion. So why would management all of a sudden decide to start paying a dividend? And here's what you have to understand. Meta is a company drowning in cash. Look at the 10-year free cash flow CAGR, 31.39%, going from around $2.8 billion to in 2023 around $43.8 billion. If we go over to the stock screener, we can see revenue per share over the past decade has exploded, and free cash flow and earnings per share have followed, and they've also maintained very high levels of return on invested capital. And if we jump over to my balance sheet breakdown, come up here and plug in Meta, what we'll see is the company is absolutely drowning in cash. Look at the total assets. $229 billion versus total debt of just $37 billion. That's a debt to assets ratio of just 0.16. If we look at the current ratio again, current ratio lets us know how easily a company can meet its short-term obligations. And all it is total current assets divided by total current liabilities. And for most companies, we want to see a current ratio of at least above 1. Well, Meta is sitting at 2.67, so their total current assets is 2.67 times higher than total current liabilities as of the end of 2023. Now, the main focus for big growth in tech companies is to heavily reinvest back into the business, and rightfully so. But here's what you have to understand. Meta had so much cash on hand that they started investing capital into areas that really didn't provide a lot of return on investment. For example, Meta spent over $36 billion trying to build out the metaverse, but has very little to show for it. So because the company has so much cash on hand and is already heavily reinvesting back into the business, they decided it's now time to start paying a dividend. Now, this isn't anything new for tech companies. We've seen companies like Microsoft and Apple. They've both grown at a high rate over the past decade and have still paid out dividends during that time period. And it's worked out really well for those companies. And now we're seeing companies like Meta and Google follow. And in fact, if you work out the numbers, we can see the payout ratio for Meta as of 2023 data would come out to only 10%, and the cash flow payout ratio would come out to only 11.74%. So the company is still having around 90% of its free cash flow to do things like reinvest back into the business. So I actually think this is a great move by Meta. This will help the management team ensure that they're focusing on the highest return on investment projects. Now, a few years ago, Meta actually changed its name from Facebook to Meta Platforms and now trades as a stock ticker Meta. And a lot of people at the time were critical, but it really makes sense now. Look at this. 3 out of the top 4 social medias are owned by Meta. We can see Facebook coming in at number 1 with over 3 billion users. They also own Instagram and WhatsApp. And the result of this is it gives Meta 2 different network effects. The first would be a data networks effect. The more customers Meta gets, the more data they have, and the better product they can create, which then in turn leads to more customers. It's a circle, and it's really powerful. And then also the more customers that they have, the higher value they can have for each customer. So in some ways, this gives the company a sustainable competitive advantage. As they grow larger, they become more powerful. Now, when you're looking at the users for each of these platforms, you might think Meta's best growth days are behind them, but that hasn't proven to be the case yet. Back in June, Meta Platforms said that the number of daily active people across its products grew to 3.27 billion on average for June 2024, which is an increase of 7% year over year. So if we put this into a little bit more perspective, again, right now they're at 3.27 billion active users. So right now they're at 3.27 billion. But if you look at where they were at the end of Q4 of 2024, it was about 2.03 billion. Keep in mind, as of right now, there's about 7 to 8 billion people currently in the world. So Meta is quickly approaching half of the entire world using its products, which again goes back to that network effect. Now, Meta has another earnings report coming up fairly soon. We can see it's going to be announced post-market on October 30th. And if we look at the earnings per share revisions, it looks like analysts are pretty bullish on this upcoming earnings report. And if we look at the most recent one, they saw beats on top and bottom lines. And to get some quick insights on this recent earnings report, like we already saw, 3.27 billion on average for June of 2024 when it comes to family daily active users, which was up 7% year over year. Now, Meta makes the vast majority of its income from ads, and ad impressions delivered across the family of apps increased by about 10% year over year, along with their average price per ad increasing by about 10%. And then if we take a quick glance at the capital return program, we can see share repurchases were about 6.32 billion, while the common stock and dividend payments were sitting at about 1.27 billion. So yes, they are paying out dividends, but buying back stock is still the focus for this company. If we go back over to our stock screener, we can actually see shares outstanding right there. In 2017, it was sitting at about 2.9 billion, and at the end of 2023, it's sitting at about 2.57 billion. So they have been buying back some shares, which can be very effective if you're buying back the shares when the company is undervalued. And like we saw, it looks like for a long time period, especially in 2022, the company was definitely undervalued, which again will boost all of those per share metrics when you're buying back shares. Now, if we jump over to the profitability and income statement spreadsheet, which by the way, if you'd like to be able to use any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description and get a 7-day free trial. But we can see here, I've already plugged in the Meta stock ticker. And like we already know, yes, earnings have exploded over the past decade, and so has revenue at a pretty high rate. We can see a 5-year revenue CAGR of about 19.2 and a 10-year of 32.8, and the 10-year net income CAGR at 38.6 and the 5-year at 12%. But here's what's also really impressive about this company that gives them a huge advantage. Look at the gross profit ratio. The 10-year average is sitting at 81.95%, so a very high gross profit ratio, and in 2023 it's sitting at about 80.76. So we can see it's fairly stable during the duration of the past decade. That's typically a sign of a high quality company. If there's two things you should quickly look at to know how high quality of a company is, look at the gross profit ratio and also look at return on invested capital. Typically, I want to see above 10%, and very high quality companies are typically closer to 20%. And it looks like Meta checks both of those boxes. So with all that being said, is Meta trading at a good value at $590.93 per share? And how in the world was the stock so sold off? And this is actually a really important lesson in market psychology. Here's what we know. Market sentiment often follows market prices. Now, what does that mean? Well, when the share price of a stock goes down, it means people think the stock is bad, and when the share price goes up, they think the stock is good. But you have to learn to understand the underlying fundamentals and the potential growth of these companies. And most importantly, you have to be able to think for yourself. Everyone thought Meta was a terrible buy in 2022 when they were trading below 100 a share, but now everyone thinks the company is amazing at $589. Now, to value a stock like Meta, there's actually one certain valuation I really like to look at, and that is the reverse discounted cash flow analysis. Now, typically when we look at a discounted cash flow analysis, we project a free cash flow growth rate to see what the company is actually worth. But in this scenario, when we're looking at more of a high growth stock like Meta, we want to see how much free cash flow growth is currently priced into the stock. So again, we're going to be using my ticker data reverse discounted cash flow sheet. What we'll do is we'll come up here and plug in the Meta ticker. And what we'll see is all this data will automatically load in, again, thanks to the ticker data add-on. Now, here's what we can immediately see. Again, the current share price of Meta is sitting at about $590 per share. And if we were to assume 0% free cash flow growth moving forward, the value of this company would be sitting at about $233.02 per share. So again, how much growth is currently priced into the stock? We want to get this number to match the current share price to find out. So if we bump up this free cash flow growth rate to about 8%, we could see we come to a reverse DCF price per share of 407, still quite a bit below that current share price. If we bump it up to 10, we can see we start getting closer at 467, and if we put it at 12, we start getting very close. And if we plug in 13, we can see we get even closer. So let's go ahead and plug in 13.5. And it looks like that's when we start getting very close to the current share price of the company. So what this tells us is the market is currently pricing in around 13.5% free cash flow growth into Meta stock. Now the question we have to ask ourselves is that justified? Because if you do think it's justified, then perhaps you think the company's trading at fair value. If you think it could be even higher, then the company's probably undervalued. And if you don't think they'll grow free cash flow that fast, then the company is overvalued. In my opinion, I think this free cash flow growth rate is probably very realistic for the company, and it could potentially be even higher. And then the other valuation I want to quickly glance at is actually one I haven't used very often, but I think it's kind of interesting to use it in meta scenario here, and this is Bogle's valuation. And I do have a video on how this valuation works, and this automated spreadsheet is also on tickerdata.com, but the general idea is the earnings growth plus shareholder yield plus minus multiple expansion should tell us the expected return of a stock. So I'll break it down for us, but let's go ahead and come up here and plug in Meta. Now to start off, we need the earnings growth projection for this company. If we look over here, we can see the earnings per share growth rates, how they've grown year over year, and the compounded annual growth rate. And obviously it's been really high during this time period. The company's absolutely exploded. Now moving forward, if you look at analyst expectations, and we also kind of get an idea of what the free cash flow growth should be like, we could go with a growth rate of around 11 to 12%. So let's go with about 11.5% in this scenario. Now we need the shareholder yield. Now, what is shareholder yield? I actually need to make a video on this sometime, but basically we're going to take the dividend yield and then also add the buyback yield. And the buyback yield is basically telling us what percent of their shares they're actively buying back. So if we come down here, we can see over the past few years, what percent of shares they have been buying back. So it looks like right through here, it was either between around 0.1 to around 1.25, but over the past couple of years, they've actually bought back a lot of stock, again, likely because the company was so undervalued. So the average buyback yield was about 2.27%. That's about how much on average every single year of their shares they were buying back. So if we come up here, maybe we think moving forward, the stock is priced a little bit higher, but they're still buying back stock. Maybe the buyback yield will be around 1.5%. In this scenario, we come to a shareholder yield of 1.84%, which is now shown right here. But then finally, we have multiple expansion. And in reality, in some cases, it could be multiple contraction, meaning they're going to trade at a lower multiple. Now, what I want to do is come over here to Seeking Alpha and look at how the price to earnings ratio for Meta has changed over the past 5 years. If we click on 5 years here, here's what we can see. Obviously, during 2022 and up to late 2023, the company was severely undervalued. In fact, at one point, that price to earnings ratio for the trailing 12 months got as low as just 8.45, which is pretty insane to think about. But on average, it looks like for the most part, that price to earnings ratio has remained in the upper 20s. And I think that's pretty justified for this company. Again, we're talking about a high growth tech stock. Now, if we jump back over to Bogle's valuation and look at this price to earnings ratio, here's what we can see. The average price to earnings ratio over the past 5 years was sitting at about 23.94, but to be fair, we have a huge outlier in 2022 when it dropped all the way to about 13.94 on average. We can see these other 4 years, it's quite a bit higher, typically closer to around 25 or above. Now, the current forward price to earnings ratio is sitting at about 27.36. So let's say in this scenario, we think over long term, Meta is going to trade at a slightly lower multiple. What we can do is come up here and we'll say that multiple will be about 1% lower. We could do minus 1% and hit enter. Now what we're seeing here is the expected annual return we should see from Meta stock over the long term, because we have to remember, in the short term, share prices are easily changed by news and by the media and market hype, but over the long term, share price is determined by earnings and free cash flow growth and also by either multiple expansion or multiple contraction. So again, I do think Bogle's valuation is an interesting way of looking at things. So there's no doubt Meta is a high quality stock. I think they have a lot of competitive advantages and the company is trading right at its 52-week high. But with that being said, I do think they're actually trading pretty close to around fair value right now. When you look at how the company's historically been valued based off their price to earnings multiple, and when you look at the earnings projections for the company, I still think they're trading at a decent value. Now obviously, you don't want to buy them right now for the immediate dividend income, but the dividend growth potential from this company is absolutely massive. As the company begins to mature, they'll focus on growing that dividend at a higher and higher rate. I'll be really interested to see what kind of decision management makes in regards to the dividend next year, because I think they could easily, very easily have dividend growth rates of 20% or above if they should choose to do so. So go ahead and let me know what you think of Meta stock in the comments down below if you plan on buying or selling. And again, like always, if you'd like to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.